So if you have a view of what the short-term signals are sharing with you, and you can take those trades, but if you know what the macro view of the market is doing, it can influence what you decide to do and what you decide not to do. As I've been kind of monitoring the live trading room today, Michael, I've heard you a couple times say, you know, I see the signal there, but it's not a signal that I want to take. If we just blindly take every signal, we might do well, but there's a certain amount of experience that comes from this, and knowing that the signal on the short term might be there, but it could be completely contradicted by long-term macro views, or just your sense of what may or may not be happening. So just to kind of provide some framework for this discussion, hopefully to make it beneficial to people. A couple of things that I'm seeing are, first of all, we've been in this cycle now for 12 days. We've been in a rising cycle for 12 days. And on the indexes, that starts to get to be a time period where we may start to run out of steam, and we may start to see some sort of a decline. But it's not just this arbitrary 12 days, and so we're probably going to turn and head lower. That's one factor. And what I like to do, Michael, is I like to stack all of the factors together and see whether or not they are starting to present a picture of consistency, or is there inconsistency, and what does the long-term versus short-term view tell me? And even before we get started here, I think the headline needs to be very clear that we always encourage you to trade the short-term signals. That's what we do. And those short-term signals are based on the 3 9-minute charts and the 5 15-minute charts from AbleTrend. But always be alert to what the macro view is. What's the big picture view? And for me personally, that macro view comes in two forms. It comes from a daily analysis of my bar charts, which I'm going to share with you here in just a few moments. But it also comes from the longer time periods on AbleTrend. It could be the 30, 90-minute chart, or it could be the 120 daily chart, just to kind of get an overall view of where we're trading relative to certain levels of support and resistance, and whether we are consistently stacked to the upside, double stacked to the upside on all indexes, or whether we're stacked to the upside or downside on some indexes but not on others. So what you're really trying to do here is to develop a picture for yourself of whether or not there is uniformity between the indexes, consistency between the time periods, or whether it just kind of looks like a hodgepodge. When it looks like a hodgepodge, that's where I'm going to most likely sit on the sidelines and I'm going to wait. The sideline sitting approach is actually a good management technique. It requires tremendous amount of patience, but it can be some of the most challenging and frustrating part of your trading, because what you're doing is you're just kind of measuring each hour by hour that you've not taken any action. So there's this fear that you are starting to fall behind. There's this fear that you're missing out on opportunity. And there's also the reality of wanting to be an active trader, and when you're not active, you figure that you're missing out on something. So I heard Michael say earlier in the trading room that he was sitting on his hands literally so he didn't start pressing the keys on his keyboard. It can really challenge your patience. It can really challenge what you're doing and what you desire to do. So if you're frustrated and you have a position or two, and there is a situation where perhaps you've managed a position and the index continues to move against you, uh, continuing to be patient can be a challenge. It may put a strain on your trading. What I really want to emphasize here is try to make sure that you're not putting a strain on your capital, that you are keeping your capital dry, that you are waiting for confirmation of signals, waiting for confirmation of cycles. So, Michael, let's together go through your 3 9-minute and 5 15-minute charts here, starting with NDX. What I see is that we are trading right at support on NDX,
Yes.
3-minute
Yes.
support. So
Yes.
we're double stacked to the upside, right?
Yes.
And that would tell us that this could potentially be a good sweet spot trade. But what would you be waiting for right now before you would want to take that trade to the upside on NDX?
Well, I'd want the current bar that's trading now, of course, is green. I like for it to close blue and close on the upper end of the bar on both indexes. I mean, on both the 3-minute and the 5-minute chart.
So
That's what
that
I'd like to see.
so that's a more conservative entry, right?
Yes.
You're waiting for confirmation that the index is starting to tick higher, as opposed to just stalling at support where it could possibly start to move below support.
Yes. That's correct.
And so we talk a lot in the live trading room about taking conservative entries or more aggressive entries. And that has to be a very individual decision. And the factors that would influence that decision for me would be, well, how many other positions do I already have open? If I'm 100% in cash, I might be a little more aggressive. Um, Other factors like my experience and my knowledge about what's going on, those are some of the other things that may also influence me. So we just saw a sell signal come on, but we wouldn't take that. We would want to wait and see. We would want to wait and see whether or not that 9-minute support quits printing.
Yes.
Okay. What about SPX? Where are we at on SPX?
Well, SPX on the 3-minute chart, we're right at uh, resistance, and really both, to be honest with you, on both of them, you're right in between the resistance and support on 3-minute, 9-minute chart.
So
And
we're
of
at
course,
3-minute resistance,
yes, and
but
9-minute support.
9-minute support.
Hmm.
So that would tell me that's a good place to not take a trade.
Exactly. 100%
And then
would not do that.
SPX is a great example of why we like to have the 3.9 and the 5.15 stacked in one workspace for ourselves. Because when you look at the 5.15 on SPX, there's no indication at all of weakness just yet on the 5.15. You're double stacked to the upside, but we're trading right at support. So on the 5.15 on SPX, that might actually be a trade to the upside. The 3.9 might keep me out of that trade because we've got resistance um, right where we're trading right now.
Yes.
So that's a great example of a chart that is giving me somewhat mixed signals, and I might still take a trade to the upside if the 515 starts to move higher. But it would all depend on other factors. How much capital am I willing to put at risk, and how many other positions do I have that are already in play? How about RUT?
RUT is just a little bit different. You can see that we broke through the 3-minute support level, or right at the close to the 9-minute support level. Bars are green, and the 515 is broke through the 5-minute support, and there's of course there's 15 below. So uh, there's no trade for me there. I mean, I'd want it to at least start back printing 3-minute again and get above that before I went long on the 3-minute chart. And of course, the 5-minute chart um, is basically the same way, but I still want the 3-minute to show me something first before I got involved to the upside.
Yeah, so 3-minute has quit printing on RUT. 3-minute has quit printing on SPX and NDX. And in fact, NDX and SPX have started printing 3-minute resistance instead. So
Yes.
I think that's a great example right there. Those 6 charts, the 2 different time periods and the 3 different indexes, that's a great example right there of proceed cautiously because there are a variety of mixed signals going on here. Your most profitable trading is going to come from consistency across indexes and time periods where you can get into a trade and it looks like they're all moving in the same direction. They're all kind of consistently headed in the same direction. Any other thoughts, Michael, on your able trend before we jump over to the bar charts?
Well, just really quick, let me just show you the NDX 30-minute. It's 30-minute, 90-minute chart. You see we got a sell signal yesterday right around 3:30. Now we still have support right here, but it usually starts, and it usually starts with a 30-90, then it's going to bleed over to 60-90, and possibly we could start to head lower. But now that's just, we don't know that yet because we've got support. But that's our first sign right there that says, hey, it's starting to print, so something's going on here, and you need to really pay attention to that because more than likely you'll see the and the 180 start to do the same thing possibly, and it might not. I mean, it could bounce and go higher from here, but I like to look at the longer time frames too also.
Well, and I think that's an important point because it's the longer time frames that are going to give you more of that macro view. Um, you might choose to stay out of a trade to the upside when um, the short-term 3 9-minute signal shows that because you're starting to see weakness on the 30 90-minute chart.
Yes.
So those are all things that really just come somewhat from experience and getting really comfortable with your charts and having some intuitive sense about what's going on. And folks, don't be afraid to miss a trade. Don't be afraid to sit idle all day. And you might be bored, or step away and go play golf or do something that you love to do. But don't be afraid to not trade. Sometimes not trading is the most profitable trading you can do, especially when your charts are looking a little questionable. So let me pull you over to my bar charts here. Now, this is my personal bias, folks. For me, the bar charts are there we go. You see that okay?
Sir, we see a great mark.
Okay, for me, the bar charts are my big picture view. You know, I equate this to something similar to like the Google Earth program, which I was fascinated with when they first came out with it. But I may know what's going on in the driveway of my house, right? I see everything there, but I can't see the big picture, what's going on in my neighbor's yard necessarily, or 2 blocks away, or the next town over. I can't see that from sitting in my driveway or in my front yard. But with the Google Earth program, I can zoom out and I can start to have a bigger overall view of what's going on. Hey, I didn't know that that toxic waste dump was 3 streets over because I don't see it from my yard. I might make different decisions about what I want to do with my property, or if I'm looking at a property, I might make different decisions about whether or not I'm interested in that based on my big picture view. So that's kind of my equivalent thought process around charts. I look at the bar charts. I don't generally use the bar charts to trigger a trade. That's not really my entry signal. I'm not looking for very short-term entry signals on bar charts. I use Able Trend for that. What I am looking for is this Google Earth. I'm zooming out. I want to see what's going on. I want to have in my thought a big picture view of, am I trading closer to the highs or am I trading closer to the lows? It doesn't mean we won't go higher, or it doesn't mean we won't go lower. I just want to know where we are, because when we're trading close to highs based on historical patterns, then there is a increasing likelihood that we're going to move lower. When we're trading close to historical lows based on a look back period of whatever I define, then the likelihood that we're going to increase or that we're going to start moving to the upside starts to increase. So here's what I see in no particular order, but kind of random thoughts on the bar charts, starting with NDX. On a 1-year daily chart, what I noticed yesterday is that we formed a pretty significant bearish divergent bar. Now, bearish divergent bar, you can see the red bar yesterday that formed. Yesterday's high of 45.89.95 was higher than the previous day's high, but the close of yesterday was in the bottom half of the day's range. In fact, it really closed at or right at about the low of yesterday. So that's a bearish divergent bar. Now, a bearish divergence is one indication of weakness in the market. It means the index was able to reach a new high, but it was not able to sustain it. And in fact, it closed lower than the midpoint of the day's range. Now today, and now I just want to be clear here, that doesn't guarantee that we're going to move lower. What I'm going to do for you is I'm going to stack up all of the factors that I look at, and we're going to see whether or not there's any consistency between them, and can we draw a conclusion from that. I have no predetermined opinion when I start evaluating my bar charts. I'm really just looking for clues as to which direction we may possibly head in the future. The future could be in the next hour, the future could be in the next week, the future could be in the next month. So there are a variety of things to consider here. But that's one. There was a bearish divergent bar on NDX, which would generally indicate a declining bias. Now we moved higher today, but I'm going to zoom in so you can see this. And it's too early in the day to draw any conclusions, but so far today we have a high that is higher than yesterday's high. So that won't change. That high will be higher than yesterday's high, even if we go higher. But so far, right now, we are trading in the bottom half of today's range. If the index closed right now, we would have a second day of a bearish divergent bar. Now, we only need to close in the bottom half. We need to close below the midpoint of today's range. If we do so, it will be a second day of bearish divergence, but we'll have to wait until the market closes. Second factor, when I take a look at prior natural levels of resistance, and we've had this discussion many times in our mid-market commentary here. We go back to the beginning of November. We go back to the beginning of December. We go back to the end of December. And those prior levels of natural resistance all tie into the current price activity. Now these channel lines, because they are drawn by me using tools provided by the charting application, they're always going to be a little bit subject to error. I'm not trying to be exact and right on the penny specific with these. I'm trying to get a global macro perspective of what's going on here. And what I see is that today we moved up to a new high in our rising cycle, and we formed a natural level of resistance so far. That's because we cycled up to that high on today's bar, and then we have moved off of that high. So the high today was 46.04, and we've moved down below that high. So we formed, at least as of right now, a new natural level of resistance. And when I look at that and I tie back to these prior natural levels of resistance, I see that we still have a slight declining slope to that channel. The corresponding parallel line that will define support is down here and is really defined by these two natural levels of support. It's really defined also back here, although this natural level of support that occurred on the 29th of September didn't come all the way down to where I've now identified support, but it doesn't change the fact that that was a natural level of support, and the subsequent support points were lower lows. So it still implies an overall declining trend. So we've got bearish divergence yesterday, possible bearish divergence today, and both of those are coming off of a declining level of resistance that goes back as far as, well, the first level, resistance point that we identified was November 3rd. So it goes back to November 3rd. That's a pretty significant time period, and we can take a step back and see all of the cycles up and cycles down that occurred during that time period. All right, I'm going to shift gears for a minute. Nope, I'm not going to change time frame just yet. Now I have one other thing I want to talk about. In this rising pattern that we've been in, the last low that we hit was on the 27th of June, and since then we've been in a pretty strong rising pattern. We're in this pattern now 12 days. Now, I challenge each of you, if you really want to get familiar with your charting, is to go back and look at the cycles and do some of your own evaluation on cycle times. Do it on each of the indexes. And cycle time is from a high to the next low and back to the next high. What did the declining cycle, how many days did that occur? How many days did the rising cycle occur? And go back for a year, go back 2 years and measure your cycle times. And you're going to start to get a sense for how long do these cycles really last? It doesn't guarantee that the minute you hit the average that you're going to reverse. None of that is guaranteed. What it's saying is that you start to get a sense for when you could possibly expect the next cycle. One of the reasons to do this exercise is because we know with absolute 100% certainty, guaranteed, there will always be a declining cycle following a rising cycle. What you don't know is when that's going to start, and so what you're doing is you're educating yourself on certain parameters, certain experience levels based on cycle times and other things that you can take into account. Okay, so we've been in this cycle for 12 days. We also have an interesting pattern that's occurred, and that is on our OOPS pattern. We actually, since the 27th, have had 5 OOPS patterns, 5 OOPS occurrences. Now, an OOPS is just basically where the trading range of one day occurred higher than the trading range of the prior day. So it forms this gap. Okay, that's a gap. This was the first OOPS that occurred right here. Now, the reason OOPS is significant is because it generally implies that, and the name implies this, that oops, there was an overreaction to whatever news was going on, or there was an overreaction to market movement. And that's why 93% of the time, in my experience, the market will recycle, move back to a point where it will, what we call, satisfy that oops, meaning that eventually the index will trade back down to the high of this bar prior to the first oops, which means that it would need to trade back down to the 42.91 range, 42.91, 300 points below where we're currently trading, in order to satisfy that oops. Now, what's interesting is 5 oops. There was one here, the second one here, third one here, fourth one, barely can tell right there, and then the fifth one this morning. So that's 5 oops patterns that occurred. Now, the last 2 of those have already been satisfied. This morning, we formed an oops pattern at the open, and then we traded back down to satisfy the oops by trading back down to the high of yesterday. And yesterday, we satisfied the oops that formed the prior day. So of the 5 oops, the patterns that have occurred, 2 have been satisfied, 1 today and 1 yesterday. That leaves 2 others. 3 others. 1 would trade back down to the 45.29 range. 1 would trade back down to the 44.68 range. And of course, we already identified the 42.91 range. So those are reasonable expectations based on experience. It doesn't, again, guarantee that it's going to happen. Another thing that's been occurring, and this is more so true on SPX than it is on NDX, but on SPX, we hit new all-time highs. When you hit new all-time highs, it ends up uh, acting almost as a headwind that you're getting into and may start to find yourself trading back down to um, uh, trading back into a declining cycle. The headwind and the new all-time highs will act all by itself as a potential natural level of resistance. On NDX, we have had Bollinger Band snaps today on 60-minute charts, on 30 minutes, and on 10 minutes. 60-minute time period here, let's take a look at this. We had Bollinger Band snaps on the first two 60-minute bars of the day. We've now moved lower. That's a great Bollinger Band snap trade right there. I know some of you in the live trading room took that trade to the downside, even though there was nothing on the short-term able trend pattern indicating to take a short-term trade. That's okay. The Bollinger Band snap pattern is a great opportunity to take a potential declining bias trade when you see it on the 30 or 60-minute charts. Here on the 30-minute chart, you can see the first 4 bars of the day were all above and outside the upper Bollinger Bands, which implies, without guaranteeing, that we're going to see some sort of a decline back lower and come inside the Bollinger Band envelope. Now, I'm going to go back to the 60-minute chart here, digging a little deeper into one chart here, because I want to show you a variety of things, and then you can do the same evaluation on whatever stock you're trading or on the other indexes. I want you to look at the AO here. So this is the awesome oscillator, and you can see the peak that formed here when we transitioned from rising momentum, which is indicated by green, to declining momentum indicated by red, and the subsequent patterns where that shifted. This transition right here, where we hit another peak of rising momentum and then transition to declining momentum, is actually a lower peak than the previous peak back on July 1. So if you take a trend line and you come across that trend, you can see here that we have a slightly declining trend. That's called a declining Twin Peaks pattern. Something I talk about in my book, The Art of Trading. When you compare that declining trend, that declining Twin Peaks pattern, which is indicative of momentum is starting to weaken, and you compare that to what has occurred with the price of the index or your stock during that same period of time, we see that the price has been rising. The difference between the rising price and the declining trend and momentum is this thing we call divergence. They are moving away from each other. When momentum is declining and price is rising, eventually momentum is going to win and price is going to snap back down. Imagine a rubber band being stretched between these two trend lines, and the price will eventually snap back lower. So when I look at Bollinger Band snaps, I look at 12 days of cycle time, I look at the AO showing a declining Twin Peaks pattern on the 60-minute charts, and I see divergence between price and the AO. I see 3 oops patterns to the downside yet to be satisfied. And like I said, on SPX, we're hitting new all-time highs. There's starting to develop for me a pattern of consistency, and the message I get from that is there is an increasing likelihood that we're going to see some sort of and I think fairly significant decline. It doesn't mean it's going to start in the next hour, and it doesn't mean that you should start taking trades to the downside based on that. I wouldn't do that personally. Now, I would take the Bollinger Band snap trade. There's not a big deal about that. But I wouldn't start trading based purely on those factors. I would then default back to my Able Trend charts and I would want to then look for my 3 9-minute signals that are indicating that we're breaking below support, 9-minute support, my 5 15-minute signals that indicates that 15-minute support has stopped printing, and as Michael already shared with you, the 30 90-minute chart, which is starting to show sell signals, and when that support level starts or stops printing on the longer term signals, what's happening is things are starting to line up. So if you want to be a more conservative trader, maybe you're trading a smaller account, maybe you're already wrapped up in managing some positions, but you still want to be active and you want to trade, I would strongly advise that you look for those levels of indicators and use them to define a conservative entry. Right now, as I look at the 60-day, 60-minute NDX chart, I see that we've dipped back down below the Bollinger Bands. We came off of a level of declining resistance that we've been in now for a couple of days and ties back to the beginning of November. That's great. What we did was we confirmed that level of resistance. Could still move higher, but as of right now, we've confirmed that level of resistance. If the 30, 90-minute Able trend charts continue to print red bars or show indications of weakness, perhaps with 90-minute support stopping to print or 30-minute support no longer printing, that's another indication that we may be moving into the beginnings of the next declining cycle. And then I'm looking for, with much greater degree of confidence, sell signals on the 3, 9, and the 5, 15-minute Able trend charts. Now, let me just say again, that doesn't mean I won't take buy signals on the short-term charts, because we have not proven yet that we're going to shift into a declining cycle. We may still be in a rising cycle here for a few days. Don't know that. So it doesn't mean I won't take the buy signals, but it just means that I'm taking those signals. I'm going to be ultra conservative on my entry, much like Michael described what he was looking for, waiting for the bar to turn blue and close in the upper part of the range before he would take that signal to the upside. Those are the layers of decision points that you have to make. So the headline here again is trade short-term signals based on Able trend. We prefer the 3.9 and the 5.15. We think that they're the best, but you may choose to trade a different time period. That's entirely up to you. So trade the short-term signals from Able trend, but be alert to that macro view. The macro view is going to give you, I believe, more confidence in taking some trades and more caution in taking other trades. So years ago, I just have a quick analogy for you here. Years ago, back in my early corporate days, I happened to be working out of our Houston office when Hurricane Alicia came through. And it was my first experience in a hurricane, and it was fascinating to see how the wind would whip in from that hurricane, and those 130, 140 mile an hour winds were just pushing everything down. They were pushing trees that we'd recently planted in the landscaping down. And then we got into this period of just complete calm and quiet. And unless you have some knowledge of what the macro view is, knowing that there will be another side of that storm coming, it could be easy to get lulled into thinking this is over. It's time to now go out and just enjoy ourselves and fix the landscape and do whatever we need to do. Don't be fooled in your trading, but also don't be afraid. Whatever's occurring right now, whether you're stuck in a position and managing it, whether it just seems like this market won't quit going in whichever direction you really would prefer it not go, it's not going to last, folks. So whatever you desire the market to do, although I strongly encourage you to want what the market wants, but if you've gotten behind on a trade, if you've gotten behind on your portfolio and you're just frustrated, be confident, 100% confident, with absolute certainty. The only thing you can guarantee in trading is whatever cycle exists now, it will reverse, because that's what the markets do. Markets move higher until they are overbought, and then they move lower until they are oversold. We create rising cycles, we create declining cycles. It's true with stocks, it's true with indexes, it's true with ETFs. Everything runs in cycles. So whatever's occurring right now, if you love it, be cautious, take profits quickly. Base hits, multiple base hits, recycling your capital is going to win for you more than trying to hit home runs. If you're in a cycle that is working against you, be confident that at some point that cycle is going to reverse, and have you aligned yourself without overextending your risk to benefit from that move when that occurs. Only you can answer that. The management techniques that we use in the live trading room, that we teach through our Profit Accelerator program, and that we teach through our daily position reviews and Profit Builder and our Platinum service, those are the management techniques that we use. Not everybody would necessarily agree with our management techniques, and we're not asking you to agree. We're just sharing with you what we are doing. And if we make mistakes, if we get into bad trades, if we manage and it takes a period of time, that's on us, because this is my capital that we're trading. We're just sharing with you what we're doing. We're profiling it for you. So become a wise trader by having a global view of what's going on, a big picture view. Make your decisions cautiously and carefully. Don't be afraid to get in. Don't be put off, but never, ever, ever overextend your capital and put it at risk to a point where you would send me an email and say, well, I can't make this trade because my broker says I don't have enough capital to make that trade. That problem did not occur at that moment that your broker said you don't have enough capital to make that trade. That problem started when you started creeping into a zone of overextending your capital. So be cautious, be careful, but don't be afraid of taking positions. Don't be afraid of following the signals. And if the signals are all questionable, they're all kind of a mixed of some of them say one thing, some of them say another, then sit on the sidelines until you have a clearer view. In my hurricane situation, when I went through Hurricane Alicia, I saw clearly what was happening outside. I saw clearly what was happening to, my fleet of delivery vehicles, to the landscaping, to certain windows on the building. I saw all that, and could have been lulled into thinking, oh, this is never going to end. Well, every other thing in life, is going to cycle back to its norm at some point. So you got to trust that with trading also. It's going to cycle back to a new low or a new high. It's going to cycle in the opposite direction than the current cycle. And again, hopefully not being too redundant, if the current cycle is benefiting you, the longer it lasts, the more cautious and tentative you should be without being afraid to enter and take advantage of it, but confirm your entries. If the current cycle is working against you, have confidence that it's going to reverse, and at some point it's going to benefit you, as long as you have aligned yourself to win when that occurs. All right, so I hope this is helpful to you. Happy trading, everybody. We certainly appreciate you being part of our live trading room. And I'm looking forward personally to the next down cycle. One last thing I will say, just focused here on NDX. If I look at the next potential of the next down cycle, where could we come down to? I'm just going to arbitrarily find a point on support here. 45.21 is one level of support. There's another level of support out there that could take us down. Let's see here. We extend that out, maybe 44.69. There's a whole nother level of support that we traded at as recently as the 27th of June, which could take us down around the, let's just say, 4,200 range. Is that possible? Is it practical? Is it reasonable? Well, the last time we hit a high prior to getting into a strong declining cycle, we were at 44.66 on the 23rd of June, and we traded down to 41.80 on the 27th of June. There was a strong declining cycle. Bollinger Band snaps were telling us that we were going to have a rising cycle at some point, and look, it snapped back and we got into a very strong rising cycle. These are the types of non-emotional evaluations you can do on your charts, evaluating your positions, evaluating your portfolio. And if you're uncertain, then sit on the sidelines and wait. You might miss some opportunity, but you're going to feel more confident then when you do enter into your own positions. All right, thanks again, everyone, for being here. Really appreciate it. And Michael, thanks for your thoughts on the charts today.
No problem, Mark.